DeFi has always attracted users with yield. Lending markets, liquidity pools, staking vaults, derivatives protocols, liquid staking products, and automated strategies can all display APYs that look far more attractive than traditional finance products. But the number on the screen is only the starting point. The real question is not simply, how high is the APY? It is, where does the yield come from, and can that source continue? That question is especially important in DeFi because some returns are backed by actual economic activity, while others are mainly funded by token emissions, temporary incentives, leverage, or speculative demand. Real yield in DeFi generally refers to returns supported by recurring activity such as trading fees, borrowing interest, protocol fees, staking rewards, or other revenue sources. These are the kinds of returns that come from real usage, like traders paying fees on a decentralized exchange or borrowers paying interest on a lending protocol. Unsustainable APYs, by contrast, often depend on newly issued tokens, treasury subsidies, or user growth that may disappear when market conditions change. For example, a protocol might offer. Most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. A high yield by burning its own token or subsidizing returns from its treasury. But if the token price drops or the treasury runs out of funds, those returns could vanish overnight. This distinction matters because high APYs alone do not always mean a better investment. A lower yield backed by recurring usage may be healthier than a much higher APY funded by inflationary rewards. Users should check whether the rate is variable, boosted, auto-compounded, paid in volatile tokens, or based on short-term historical data. Revenue does not remove risk. Even real yield can involve smart contract risk, impermanent loss, liquidation risk. Understanding these factors is key to evaluating DeFi opportunities more carefully. The next signal to watch is how protocols sustain revenue sources through market cycles and whether they can maintain yield without relying on token inflation or user acquisition. As the DeFi space matures, users are increasingly looking for transparency and sustainability in yield-generating products. A protocol that can consistently generate income from fees and usage is more likely to offer stable returns over time. On the other hand, protocols that rely on token emissions or short-term incentives may see their yields collapse once the incentives are removed or the market turns. Investors should also consider the broader economic model of a protocol. Does it have a clear path to profitability? Are the fees collected high enough to justify the yield being offered? And how does the protocol plan to maintain or grow its user base without relying on external funding? These are all important questions that go beyond just looking at the APY. As DeFi continues to, most people arrive after the move is obvious and the easy upside is gone. We focus on serious crypto education and high-quality signals before the crowd rushes in, so you can understand the setup earlier and move sooner. If you want that edge, visit the link below now. Evolve, the focus is shifting from chasing the highest numbers to understanding the underlying mechanics that make those numbers possible. Real yield is not just about getting a return. It's about getting a return that can last, even when the market is down or user activity slows. By focusing on sustainable revenue sources and avoiding overly optimistic yield claims, users can make more informed decisions and reduce the risk of being caught in a yield trap. The key is to look beyond the APY and understand the real economics driving the yield.